A single choice on a form can change your entire financial year. Your tax filing status dictates so much. This often overlooked detail affects how many thousands of dollars you keep or thousands you owe the government. Understanding its mechanics is crucial for every taxpayer. There are five main categories one needs to consider. First, there is single status. This is for unmarried individuals or those legally separated on the last day of the tax year. For 2023, the standard deduction for a single filer was $13,850. In 2024, that number climbed to $14,600. This means a single person could subtract that amount from their taxable income right away. Think about that. That is a significant chunk of money not taxed. Their tax bracket thresholds are also different from other statuses. For instance, a single filer earning up to $11,600 in 2024 falls into the lowest 10% bracket. An income from $11,601 up to $47,150 hits the 12% bracket. These numbers shift dramatically for other statuses. Next, we have married filing jointly. This status is for couples legally married on December 31st of the tax year who choose to file one combined return. It often offers the most tax advantages for many couples. The standard deduction for married filing jointly in 2023 was $27,700. For 2024, it rose to $29,200. That is almost double the single deduction. Their tax brackets are also more favorable for higher incomes compared to two single individuals each earning half of the combined income. For example, a joint income up to $23,200 in 2024 is taxed at 10%, from $23,201 to $94,300. It is 12%. This combination of higher deductions and wider lower rate brackets can save couples thousands. Then there is married filing separately. This option is for married couples who choose to file individual tax returns. This status usually comes with disadvantages. Both spouses must either itemize their deductions or take the standard deduction. They cannot mix and match. If one spouse itemizes, the other must also itemize, even if their itemized deductions are less than the standard amount. The standard deduction for married filing separately is exactly half of the married filing jointly amount. So for 2024, it is $14,600 per person. This often results in a higher overall tax liability for the couple combined. Certain credits also become unavailable or limited. For example, you might not be able to claim the earned income tax credit or education credits. Even the child tax credit can be reduced or eliminated for married filing separately filers depending on their adjusted gross income. It is a status rarely beneficial unless specific circumstances like one spouse having significant medical deductions or wanting to avoid joint liability for the other's tax issues come into play. But financially, it is often the worst choice. Earning. Another important status is head of household. This is for unmarried individuals who pay more than half the cost of keeping up a home for themselves and a qualifying person. This qualifying person must generally live with them for more than half the year. The standard deduction for head of household in 2023 was $20,800. For 2024, it increased to $21,900. This is significantly higher than the single deduction and offers a much better tax break. The tax brackets for head of household are also more generous than the single brackets. For instance, income up to $16,550 in 2024 is 10%. Income from $16,501 up to $63,100 is 12%. This status is designed to provide tax relief for single parents or those supporting other dependents. It acknowledges the increased financial burden of maintaining a household with dependents. Missing this filing status when eligible could cost you hundreds, maybe even thousands in lost savings. Finally, we have qualifying widow, with dependent child. This status allows certain widowed individuals to use the married filing jointly tax rates and standard deduction for 2 years after their spouse's death. This is provided they have a dependent child and meet other requirements. To qualify, the taxpayer must not have remarried. They must have been able to file married filing jointly in the year their spouse died, and they must pay more than half the cost of keeping up a home for a qualifying dependent child who lived with them for the entire year. This status essentially gives the surviving spouse a financial bridge after a significant life event. For example, if a spouse died in 2023, the surviving partner could potentially use this status for 2024 and 2025. This means they would get the 2024 married filing jointly standard deduction of $29,200. It provides stability during a difficult time. The implications of these statuses extend far beyond just the standard deduction. They directly influence your eligibility for tax credits. Take the child tax credit, for example. For 2023, it was up to $2,000 per qualifying child under 17. Up to $1,600 of this could be refundable. This means even if you owed zero tax, you could still get money back. Your filing status often impacts the adjusted gross income or AGI thresholds for these credits. For a single filer, the phase-out for the child tax credit begins at an AGI of $200,000. For married filing jointly filers, it begins at $400,000. This vast difference means two people with the same combined income might qualify differently based on their marital status. The Earned Income Tax Credit, or EITC, is another critical one. For 2023, the maximum EITC for a taxpayer with 3 or more qualifying children was $7,430. For those with 2 children, it was $6,604. With 1 child, it was $3,995. For those with no children, it was $600. The AGI limits for EITC also depend heavily on filing status. A single filer with 3 children needs an AGI below $56,838 for 2023 to qualify for the full credit. A married filing jointly filer with 3 children could have an AGI up to $63,398. These are substantial differences. Education credits like the American Opportunity Tax Credit or the Lifetime Learning Credit also have AGI phase-outs linked to filing status. The American Opportunity Tax Credit can provide up to $2,500 per student for the first 4 years of post-secondary education. 40% or $1,000 is refundable. The Lifetime Learning Credit can provide up to $2,000 per return for qualified education expenses. Their income limits are different for single or married filing jointly. For example, in 2023, the American Opportunity Tax Credit began phasing out at an AGI of $80,000 for single filers and $160,000 for married filing jointly filers. That is a 100% difference. Even something as seemingly simple as the credit for other dependents, which can be up to $500 per qualifying person, is affected by these AGI limits. Even your ability to deduct certain expenses can be tied to filing status. For instance, medical expense deductions, you can only deduct medical expenses that exceed 7.5% of your adjusted gross income. A lower AGI means a lower threshold. Your filing status directly influences your AGI through different deductions and income considerations. It creates a domino effect. If you are married filing separately, you might face limitations on contributing to certain individual retirement accounts or IRAs. Specifically, if you lived with your spouse at any time during the year and file separately, your deduction for traditional IRA contributions could be significantly reduced or even eliminated if you or your spouse are covered by a retirement plan at work. The income phase-out ranges for 2024 for someone covered by a workplace plan and married filing separately are a mere $0 to $20,000. Compare that to single filers who have a range from $83,000 to $93,000. That is a huge penalty for filing separately. Under those conditions, the tax laws are a complex web. Misunderstanding or incorrectly choosing your filing status can have massive financial repercussions. It could mean paying thousands more in taxes than necessary, or it could mean missing out on thousands of dollars in refunds or credits you were otherwise entitled to. Imagine losing $2,000 from the child tax credit and an additional $700 from a lower standard deduction. That is $2,700 gone simply by not understanding this one fundamental aspect of taxation. Or consider a single parent who qualifies for head of household but mistakenly files as single. They would miss out on a standard deduction difference of over $7,000 in 2024. That is the difference between $14,600 for single versus $21,900 for head of household. This mistake directly translates into more taxable income and thus a higher tax bill. For couples considering divorce or separation, the decision of filing status is particularly critical. Filing jointly, even if separated but not yet divorced, can sometimes lead to lower taxes, but it also means joint liability for the entire tax bill. If one spouse has undisclosed income or makes an error, the other spouse is on the hook. Filing separately avoids this joint liability, but often comes with a higher tax cost mentioned before. This choice involves a careful balancing act between financial savings and legal protection. The decision is not purely financial. It involves legal implications and risk assessment. Many people are unaware that if they divorce by December 31st of the tax year, they cannot file as married filing jointly. They must file as single or head of household if they qualify. This timeline is strict and non-negotiable. Even seemingly small life changes like having a new baby can completely alter your optimal filing status. A new baby can make you eligible for head of household if you were previously single. It could increase your child tax credit by $2,000 and potentially other child-related credits or deductions. Your AGI could be reduced, leading to qualification for other income-dependent benefits. The timing of these life events matters intensely. Being born on December 31st versus January 1st can mean an entire year of tax benefits or an entire year of waiting. The system is precise to the day. People often assume their filing status is obvious. They think if they are married, they file married filing jointly. If they are not married, they file single. But life circumstances are more complex. A single person supporting their elderly parent could be head of household. A widow with a dependent child for 2 years after their spouse's death qualifies for qualifying widow. These nuanced rules exist to provide fairness and recognize different household structures, but taxpayers must actively understand and apply them. The IRS provides publications like Publication 500 and one which details who can claim a dependent. Publication 505 discusses tax withholding and estimated tax. These documents are packed with numbers and rules. For example, to be a qualifying child, a dependent must be under 17 at the end of the tax year for the child tax credit, or under 24 if a full-time student and younger than the taxpayer, or any age if permanently and totally disabled. They must have lived with you for more than half the year, and they cannot provide more than half of their own support for the year. Each of these criteria has specific age and income thresholds. Your filing status directly impacts your withholding as well. If you have an incorrect filing status selected on your Form W-4 with your employer, you could be having too much or too little tax withheld from your paycheck. If too little is withheld, you could owe a large sum at tax time and potentially even face an underpayment penalty. This penalty is calculated based on the amount of underpayment and the interest rate set by the IRS. For the first quarter of 2024, the underpayment interest rate was 7% per year. That is a 7% penalty on money you should have paid throughout the year. If too much is withheld, you are essentially giving an interest-free loan to the government throughout the year, when that money could be earning interest for you in a savings account or investment. For example, a worker making $70,000 a year who incorrectly files as single when they should be head of household might have several $100s extra withheld each month. That is thousands over a year. Ignoring your filing status is like ignoring a fundamental lever of your personal finance. It is not just a bureaucratic checkbox. It is a financial strategy tool. Every single individual and family needs to revisit their filing status at least once a year, especially after any major life event. Marriage, divorce, birth of a child, adoption, death of a spouse, or even a dependent moving out are all triggers. The date these events occur can be critical. A marriage on December 31st means you are considered married for the entire year, for tax purposes. A divorce on December 31st means you are considered unmarried for the entire year. This extreme precision affects everything. The difference between $2,200 in estimated taxes or $3,000 in estimated taxes could hinge on a single day. A $1,000 difference in income could move you into a higher tax bracket for some statuses. For others, it might not change a thing. The complexity is designed to be fair, but it demands attention. Your tax filing status isn't just about how much you pay. It also affects other areas. Your eligibility for certain government assistance programs or student loan repayment plans can consider your AGI, which is influenced by filing status. Sometimes filing separately might seem like a good idea to keep incomes distinct for other purposes, but the tax cost can be staggering. A medical professional earning $150,000 and their spouse earning $80,000 might opt for married filing jointly to maximize their standard deduction and lower their overall tax rate. If they file separately, their $80,000 earner spouse might lose out on thousands in deductions or credits because their individual AGI is still too high for certain benefits when considered separately. And the higher earner also loses some benefits. Their combined tax bill could easily jump by $3,000 to $5,000. The IRS tax code contains thousands of pages. Filing status is just one piece of this puzzle, but it is foundational. Getting this right is the first step to accurate tax planning. For 2024, tax brackets for single filers climb from 10% to 12% to 22 to 24 to 32 to 35%, and finally 37% for incomes over $600. $93,750. 4. Married filing jointly, those same percentages apply, but at much higher income thresholds. For example, the 32% bracket starts at $383,900 for joint filers versus $243,725 for single filers. That is a difference of almost $140,000 in income before hitting that higher rate. This means significant tax savings for couples compared to two individuals earning the same combined amount. It is a game of numbers, and knowing your place within those numbers. Filing status is a primary variable in that game. Failing to correctly assess it means leaving money on the table or setting yourself up for an unexpected tax bill come April 15th. Many taxpayers rely on tax software or a preparer. Even with those tools, understanding the basics of your filing status and its enormous financial implications remains your responsibility. The software needs accurate input from you. A human preparer asks questions. If you do not know the answers or provide incorrect ones, the outcome will be flawed. This one detail could make a difference of hundreds or even thousands of dollars in your pocket annually. It truly changes everything. The tax filing system is built on these choices. Ignoring them is not financially sound. It is a path to unnecessary burden.